Top 5 401k mistakes you need to avoid at all costs. Trust me, I've made these mistakes too. And the first mistake is not getting your employer match. I've made this mistake in the past by not contributing enough to get the free employer contribution. Some of you watching this may be thinking, well, duh, everybody knows this, right? The reality is that about 17 million Americans don't get their employer matches because they're simply not contributing enough. But sometimes it's not even their fault. Because when I first got my 401k, I didn't really understand how the employer match worked. I don't want you to shame people for not understanding the employer match system, but help me educate them by sharing this video. And I also understand that there are also some companies that don't offer any employer match. So there's not much we can do about that one. So let me show you this 401k spreadsheet, and you can download it for free by visiting firesidechat.com/resources. You should also check out my Fireside Chat shop to check out the books and equipment I use for my YouTube studio at firesidechat.com/shopping. But anyway, let's say your annual gross income is $75,000. Your employer matches 50% of your personal contribution at 6%, which means your employer will contribute 3% of your gross income. So you'll need to contribute a minimum of 6% to get 3% of your employer match. So if you combine both personal and employer contributions, you're effectively saving 9% of your gross income towards your 401k. And let's assume that your income goes up by 2% every year, starting at the age of 25, which means your employer match will also increase by 2% every year. Just by increasing your personal contribution by 1% every year, your 401k could grow from $0 to $2.45 million by the time you turn 60 years old. So having your employer match could be a big difference maker in your 401k. And if you look at my financial independence checklist, I'm always going to prioritize the employer match before I max out my HSA and Roth IRA. Just by contributing 6% of my gross income and getting 3% of my gross income for the employer contribution, I'm effectively saving 9% of my gross income when I'm on step 3 of this checklist. If you don't get an employer match, then you can simply skip this step 3 and go straight to step 4, which is to max out the HSA and Roth IRA contributions. And mistake number 2 is leaving the company before you're fully vested. And a lot of people looking at their 401k balance thinking that that's the entire balance that they own. So for example, let's say you have $50,000 in your 401k, but you may actually just own $40,000 out of that $50,000 because the other $10,000 came from your employer. So if you decide to leave the company, depending on your company vesting policy, you might have to give a portion of that $10,000 back to the company because you didn't stay with the company long enough. So you just can't take the company's employer match and then run off to another company. They want you to contribute your time to the employer before you can take your portion of the employer match. The vesting schedule can be different from company to company. The broker that manages your 401k will keep the employer match in a separate pot of money. If you log into your 401k website, it's gonna tell you how much you contributed and how much your company contributed so far. And make sure to contact your HR to find out your vesting schedule if you don't know. From my personal experience, my 401k had a match, but if I had quit my job under a year, then I wouldn't keep any of the employer contributions. If I quit after a year, but less than 2 years, it was 25% of my employer match that I got to keep. If I quit between years 2 and 3, then it was 50% of the employer contribution I got to keep. I had to work at the company for at least 3 years to be fully vested. So keep that in mind before you decide to quit your job. But don't let it stop you from getting that next job if you're going to have a significant pay increase, better benefits, or doing something that you're gonna love. If you're gonna lose some or all of your employer contribution, you can always schedule a session with me to calculate how long it'll take you to make all that money back with your new employer. And I encourage you to join my private Facebook group or become a member of my channel because I have a public live stream and private group session every other Wednesday to talk about all kinds of financial independence investment and early retirement strategies, you can visit firesightchat.com/pricing or firesightchat.com/coaching to schedule your financial coaching session. And mistake number 3 is maxing out your 401k way too soon in the calendar year. This is actually a very common mistake for people on the financial independence journey who max out their 401k contributions every single year. In 2023, if you're under the age of 50, you can contribute up to $22,500. So if you get paid every 2 weeks, you should contribute $866 every 2 weeks to your 401k, and then you'll achieve $22,500 by December 2023. If you're over the age of 50, the maximum contribution limit is $30,000, and that's about $1,154 every 2 weeks to max out by December 2023. But what some people did in 2022 was contribute way too much to take advantage of the bear market. And they maxed out the contribution by September or October, and they missed out on the employer match in November and December. Because when you don't contribute anything to your 401k, your employer won't give you the match unless your employer has a special provision in your 401k. Depending on your gross income, missing out on the employer matches for just 2 months could be a lot, right? And mistake number 4 is over contributing to your 401k when you have multiple jobs. When you take advantage of the employer match from both employers, but you have to keep in mind that your total 401k limit is $66,000 between employer and employee contributions. If you're 50 or older, it's $73,500. So your personal contribution as an employee is still limited to $22,500 no matter how many 401k accounts you have. Your employer could theoretically contribute up to $43,500 with a total of $66,000 if you're under the age of 50. The other exception is if your 401k plan has the after-tax contribution option, but I'll talk more about that in next week's video, so be sure to subscribe if you haven't done that already. So you could theoretically contribute $11,250 to one of your 401ks and $11,250 to the other 401k. And I will only do this if both of your employers give you the employer match. If only one of your employers gives you the 401k match, then I would just focus on the one 401k account that gives you the employer match and leave the other 401k account alone. But just be careful that you don't go over the personal contribution limit because your employers don't know each other or talk to each other, right? So they're gonna assume that you're contributing up to the maximum of $22,500 with that one 401k. So you'll have to manually calculate how much you're contributing to each 401k account if both employers give you the match. Otherwise, you're gonna be penalized by the IRS for over contributing to your 401k by the time you file your taxes next year. And mistake number 5 is withdrawing your 401k or taking out a 401k loan to pay off your high interest debt. And I understand that you may be struggling with car loans, credit cards, or personal loans, but taking out a 401k loan or withdrawing your 401k early could devastate your retirement planning in the long term. And trust me, I've done this in the past and it's hurting me right now, almost 10 years later. Your 401k is supposed to be your long-term insurance plan that can supplement your pensions and other investment vehicles you have to retire on. So if you make a 401k withdrawal before 59 and a half, you're gonna owe federal income tax depending on the total distribution, and that could be 10, 12, 22, 24% or higher. In most cases, I've seen it's around 22%. So for example, if you withdraw $50,000 from your 401k, you're paying $11,000 in federal income tax if you're in the 22% marginal tax bracket. You're also paying an additional $5,000 in a 10% early withdrawal penalty. If you live in a state that requires you to pay state income tax, you're gonna owe that too. So you could be looking at paying 30 or 40% in total taxes and penalties if you touch your 401k before the age of 59 and a half. Not to mention that it's gonna hurt the long-term growth of that $50,000. With a 7% average annual return, that $50,000 could turn into $405,000 $300,000 in 30 years. So not only are you paying 30 or 40% in taxes and penalties, but you're potentially losing $350,000 in gains for 30 years or $150,000 in gains for 20 years. When it comes to my 401k, Roth IRA, or HSA, I do not touch any of them because I want them to grow to $3, $4, or $5 million or more by the time I'm 60 years old. Those numbers are not ambitious at all because I max out my contributions every single year. My money is not at all tied up with my retirement because I diversify my investments. I have long-term investments with 401k, Roth IRA, and HSA. I have intermediate investments with real estate, taxable investment accounts with dividends and growth stocks. I also have a short-term cash reserve in my high-yield savings accounts like my emergency fund, travel fund, discretionary fund, and home improvement. This way, I'll never have to borrow or take money out of my 401k, Roth IRA, or HSA. And if you want to know more about my 3-bucket investment strategy for financial independence, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe and I hope to see you in the next video. Have a good one.